Well, hello, welcome to the Lending Podcast. We're excited to have a new episode for you today. My name is Jeff Jones, and this is John Burnham, JB, as we also know him, the guru of mortgage. And we have a great episode. We want to bring to you a topic that just helps out take away barriers of applying so we can get you good information. So what are we talking about?
Right. We're going to talk about the impact of a soft credit pull versus a hard credit pull. And what is that? What does it mean? How does it affect your score? I think that's one of the most common questions we get is, do you guys pull a hard pull? Do you pull a soft pull? A lot of folks don't want a quote unquote hard inquiry on their credit. And we're going to talk about why that is and maybe what the impact to your score could be. And the quick answer is we do not do a hard inquiry up front. We do a soft credit check. So we'll kind of walk you through the process of having that initial conversation, pulling a soft credit inquiry. What does that mean? What does it give us? What kind of information do we base our decision off of? And then when do we need to pull a hard pull? How does that impact you? And as the loan moves through underwriting towards closing. So It's just such a common question. I feel like we've touched maybe all around this topic before, but never really addressed it head on.
Yeah. And we, personally have chosen as a branch not to charge our client up front for that. There are lenders out there, if you have done this before, that will actually have you make a payment to get your credit run. And that is the only fee that can be charged ahead of your closing.
That's right. A reasonable fee.
A reasonable fee.
Mm-hmm.
And so other than you paying for your appraisal, this is it. And so what that means is there's going to be different lenders out there. If you're shopping for a home and there's a lender that's asking money to do your application, that's what they're asking money for, is that credit pull. They can't take money for any other reason than that, to get your application going. A lot of lenders just don't do that. It's part of just the cost of business. We eat it on our line item. If you don't close, we're just out that money. If you do close, it's itemized and we get refunded. But that's how we do it. And most, just a numbers game. We get a lot of applications and not everybody closes. They're just seeing what they could afford. They're looking at their purchasing power. They want a very robust consultation. For us, we want a full file. And a part of that file is pulling credit. So we love the fact that we just don't charge because we don't want any barrier to be there. We don't want any excuse to have somebody delay submitting an application.
That's right. Yeah, I mean, going through the pre-approval process is already, for a lot of folks, a lot of our clients, a kind of a daunting task for some, not for everybody. And so to have that $50 charge or $100 charge or whatever it is out there, just for me, it doesn't seem like
fair.
Something that we should be charging, so we don't, right? We have those consultations up front. Our clients do the application. And let's walk through that, because one of the neat things about our software platform, our secure portal where you actually go through the application online, is when the application's submitted, there is a box that you check that says, I agree to have a soft credit pull run on my credit profile. And that automatically pulls the soft credit pull, right? The soft inquiry. And again, what is that? What's the difference between a soft and a hard pull? Well, first of all, the soft pull does not affect your score. It does, however, show
that's
up
critical
as an inquiry.
Yeah, so that's critical to put out there, because I think that's one of the big points of our episode. If you get nothing else, just know there's a difference between soft and hard. Soft will not change your scoring.
That's right. And a soft credit pull, it's something like if you apply for a new cell phone and the carrier might pull a soft credit check. You're applying for a new home internet service, they may pull a soft credit check. You're applying for insurance. A lot of insurance companies will pull a soft credit check. The difference between a mortgage soft credit check and maybe some of those other vendors that pull maybe one bureau or two bureaus, we're actually pulling a tri-merge soft credit pull, which means we're pulling Experian, we're pulling Equifax, and we're pulling TransUnion. Now, the nice thing about it, of course, is we get all three because there is a variance in score because the scoring models are different. And sometimes it's a very tight range. The scores might be really close together. Other times there's a big wide variance for a number of reasons. But what I've found with the soft pull is, let's say we pull a soft credit pull, and then maybe the next day we need to pull a hard pull. because perhaps a client's already under contract, it's moving through the process quickly. Those scores are identical.
They really are.
I mean, maybe a point or two. So when we have clients that say, I don't want a hard credit pull because I don't want it to affect my score, just know that's a valid concern, but it's only 1 to 3 points, generally speaking.
Right.
Now, we're going to dive in a little deeper on what inquiries can affect your score more. But as far as a mortgage application upfront, the soft credit check does not affect your score at all. However, it does show up as an inquiry. I had a client that got a little sideways one time because we told them it wasn't going to affect their score, but they saw it as an inquiry. Yes, it shows up just like your cell phone provider would show up as an inquiry, right? If you were applying for a new cell phone, but it does not affect your score.
Yeah.
So it's a very important factor.
So let's talk a little bit about, the different credit pulls. So a mortgage credit pull is pulling Experian, TransUnion, Equifax, like you said.
Yes.
But our score numbers are different than if somebody's like on Credit Karma or their bank or their credit card says, here's your credit score.
Right.
So how do the mortgage numbers different? Because a lot of times we'll talk to clients on the phone and they're like, I got a great credit. It's whatever, I'm gonna throw a number out, 720. And then we pull credit and it could be 780, it could be 690. Like it's not coming from the same.
Why the variance?
Yeah. So
Yeah.
So there are different credit bureaus in those three, and the way a mortgage is scored is different than most consumer credit scores.
Yeah, there's a lot of ways to answer the question, but the bottom line is there are multiple scoring algorithms, and there's actually over 100 different scoring algorithms. There's also kind of a fourth bureau that nobody talks about, which is called the Vantage. If you have a credit card account, you log in and it says your Vantage 2.0 or Vantage 3.0. I'm thinking of my credit card company that pulls a Vantage score. It's going to be a different scoring model than Experian, Equifax, and TransUnion.
Very different.
The mortgage industry has all standardized because a lot of us transfer our loans to the same servicers. We have standardized underwriting with Fannie Mae and Freddie Mac, who buy the majority of the conventional mortgages, VA, FHA loans as well. We are all standardized. So in theory, if you applied for 3 mortgages with 3 different banks on the same day, all 3 of those banks should pull the exact same score because they're pulling the exact same scoring algorithm, the scoring model. Now, why it's different is because if you're applying for a car loan or a credit card or a line of credit or a mortgage, the bank that you're applying with may be using a specific scoring algorithm for that specific trade line because it's on a mortgage. They're not selling the loan maybe to to Fannie Mae or Freddie Mac or whoever's buying the mortgage. It's auto loan or it's a credit card, and so that scoring algorithm is different.
Yeah, no, that's good. Okay,
and credit. You mentioned Credit Karma. So Credit Karma, to be perfectly honest, they may have a proprietary scoring model behind the scenes. Like it's not.
It could be one of the 100.
Yeah, it could be one of the ones that we're using on a mortgage. They may change it often. It's part of the marketing platform of these credit bureaus and the Credit Karmas of the world is that they're charging consumers in many cases for monitoring your score. Nothing wrong with that. Just know that there are ways to monitor your score without paying a monthly fee, and you have access to your credit information. And pulling a soft credit report, pulling your own credit report, does not hurt your score either.
Right.
As well as pulling a soft credit report that we would pull does not hurt your score. So that's why they're different. It's just a different scoring model. A client thinks they have a 720, we pull a 710. It's a little disheartening sometimes. Maybe we pull a 740, we might pull a better score. And we just need to talk through that and understand the score that you're seeing on your consumer scoring model is different than a mortgage score.
Yeah. Yeah. So, people are listening to this and maybe they're wondering, well, how much, what's a good score? What's a bad score? Because there are ranges.
Yeah.
And so like in our industry, it's really kind of by, 10, sometimes 20 point you're in a new bracket and then you get to another 10 score and you're in another bracket. And so we kind of have these risk matrices that go up by 10 points and sometimes 20 points, depends on where the matrix is at.
Right.
So if we pull a soft credit pull, what's a good number? What's a bad number? Just so people know.
Yeah. Well, the top tier out there is actually a 780. So if you have a 780 and I have an 820, we're actually getting the same loan
Same
pricing.
pricing.
So the top tier, kind of the walk on water credit, as I say, that's your 780 plus. And that's the middle of the three scores. So we're pulling all three, and then whichever's the middle value is what that's the qualifying score. And so from there, 760, 740, and so on, those are still top tier credit scores over 700. I would say
Over
720,
720.
is maybe the teetering point of,
Right.
okay, under a 720, there's various loan programs that we might consider in addition to a conventional loan, but it depends on the loan program. So some loan programs are not credit score sensitive at all.
Right.
Some programs are very credit score sensitive.
Right.
Even on conventional loans, if you're getting a 15-year mortgage, a 15-year fixed, it's not very those programs are not credit score sensitive. Those rates are not credit score sensitive, like a 30-year mortgage is more credit score sensitive. And then if it's a government loan, FHA or VA, those 620, 640 is really where you need to be.
Yeah.
And those rates are going to be the same.
And people, just so people know, we do close loans in the 500s,
Sure.
like 580,
580.
560.
Yeah.
There are still programs available for that.
Yep.
When you're getting into the 400s, that's when we really have great discussions about credit improvement options and roadmap a way to get betterment, because a lot of times you might not qualify.
A lot of opportunity in
Yeah.
400. Yes.
And honestly, so we just a little bit, we have a whole episode on credit improvement, episode 9, way back in the archives. Episode 9. I think I titled that one, Oh Credit.
Yes.
So check that one out if you want to talk about credit improvement.
We'll take a deeper dive on that. But back to and first and foremost, if you don't have your credit scores frozen, you should. So that's something you can sign up with Experian, Equifax, and TransUnion.
It's free. It's free to do.
They do offer paid services. You don't have to pay for the membership. You can just log in and then you have an account with them.
Yeah.
I keep my credit bureaus frozen. I've had attempted fraud on my credit. I had someone file an unemployment claim in my name. It's bonkers.
Well, and now with tax season coming up, a lot of times people's fraudulent tax returns are filed in your name, which is not fun.
So keep your scores frozen if you can. It is free. There's also a way to freeze your kids' credit scores, or your kids' socials, which I recommend you do as well. You have to do it in writing. Whole nother story. Reach out to us if you have questions on that. But if you keep your scores frozen, the main thing when you're applying for credit is make sure that you let your lender know, hey, my scores are frozen. I'm going to unfreeze them. You can do a temporary and free thaw or unfreeze them indefinitely. And then usually it's same day. So go ahead and get them unfrozen for us, and then we can pull your soft credit pull. You can put the freeze right back on there, especially if you're not buying something for a while. This soft credit pull, though, what's interesting about it, I think, is that it's super comprehensive. Like it looks no different than a hard pull on our end.
Right.
It looks no different. So we can see every single account when you open them, what the balances are, what the payments are, what your scores are, and it's a true mortgage credit report. It just does not affect your score, and therefore gives us good information to help you get pre-approved. Yeah. And it's really a good starting point.
It is, and we like to educate our borrowers. So as a lender, when we get a new application in, we have an automated email that goes out that has a link to it of what we call an opt-out pre-screen. So in this day and age, data is sold like crazy. If somebody does a hard credit pull for a mortgage on you, there are companies buying that information behind the scenes. It's not the mortgage company that's selling your information at all, so you can't blame your lender for that. It's those credit bureaus that are selling your information, which is frustrating as heck.
Yes. There's legislation on the table out there to try to prevent that. We just haven't got it passed yet.
Yeah, so you're going to be getting dozens of spam calls if you do a hard pull on a mortgage application and you have a good score. So you're going to be getting tons of calls from other lenders that are buying that data. Hey, this person's interested in a mortgage. You should call them.
Yes.
So what we like people to do, there is a way to opt out of that. And it's a link, and it opts out of all of it. And it's simple. It's really, really simple. So we encourage people, if they have not done that opt-out link, it's not just freezing your credit. It's actually opting out of spam calls.
Yep.
And you can do that ahead of time. So what we like people to do is let us do your softball. That's not going to trigger those spam calls. We get a great look at your file. We get a really robust conversation of scenarios that you can pre-approve for with the soft credit pull. And before we pull your hard pull, please follow this link and opt out of spam calls. So that's our process.
Yes.
And we think it's great because we want the best experience out there.
It cuts down on a lot of solicitations, especially if you already have a mortgage. So if you're a homeowner now and you're either going through a refinance process or you're buying another house and maybe selling yours or keeping it, renting it, and if you've been through this, as soon as you had that credit pull, your phone starts ringing. It can start ringing.
Yeah.
So doing the opt-out, it's optoutprescreen.com, or you can go to donotcall.gov and enter your information to be on the do not call list. And I've been on the do not call list since I had a cell phone, 20 years, and we still get spam calls and stuff every day. I'm sure everyone out there does. So you can just not answer them, but they're just a nuisance. They're just annoying. Yeah. So the more we can get out in front of it, it cuts down. It doesn't eliminate necessarily, but it does cut down on the amount of solicitations that you get. And we're all busy, and we just don't need more phone calls, unnecessary phone calls. Yeah. And so then, if we're through the pre-approval process with the soft credit pull, there is a point where we're now pulling the hard pull. And so hopefully our clients have done the do not call or the opt out pre-screen, and that takes about maybe 5 to 7 days to take effect, I believe. And so then we're a little further in the process. Now perhaps we're under contract. We're pulling that hard credit pull, which we do need to have in order to close the loan. Yes, it might hit your score 1 or 2 points, 3 points. And we're going to talk about the point differential here in a second, because I have another perspective I want to share on that.
Well, let's just make sure we clarify when we do the hard pull. So for those of you out there, we do a soft pull. We go through a conversation for your pre-approval, send your pre-approval letter. You and the realtor are going shopping, right? And so hopefully over those days that you're shopping, about to put an offer in, you can do the opt-out link. Then once you are under contract, you win an offer that you submitted. We get a copy of the contract. We're going to call you because we're ready to lock in your loan.
That's right.
Before we lock in your loan, we want that hard pull there so that it locks in your credit score when we lock in your rate.
That's right.
Right? That way, if something happens down the road where your credit changes, at least we locked in the credit. Sorry, we locked both of those things in at the same time, because they really mirror each other. Because if something happens during your closing and your credit drops, the risk changes on the loan and the cost might change on that rate.
Yep.
So we like doing those right when you're under contract.
And that's a good point. The timing of credit score changes is very much a mystery to most folks. Like, why does my credit score change? And I'll give you a classic example. So I have a client right now. We pulled credit. It's a 778. Just pulled credit a week ago. He got a notification on his consumer scoring model that his score dropped to a 741.
Oh, wow.
He called me immediately. This is kind of weird. My score just dropped. I said, we've already pulled your credit, and I can guarantee you a mortgage pull does not drop your score 35 points.
Right.
So what we want clients to understand is the credit inquiry itself wasn't necessarily what dropped the score. Something else in his credit profile might have changed. His credit card balance might have been updated. He might have
paid off something that had a long standing to it.
Yes.
Yeah.
And so because the credit score doesn't necessarily change on a daily basis. The credit score can change when something changes on your consumer debt side, right? So you got a new credit card. You paid your credit card down. You paid it off. You got an auto loan. You paid it off an auto loan. You got a mortgage inquiry. All those things are part of the puzzle that make up your credit score. One very important distinction, and I don't think many people know this, is if you have a revolving debt, so let's say you have a credit card and it's a $10,000 limit credit card. And it just so happens that this past month, you bought some airline tickets, you had some large expenditures, maybe you bought some stuff for your company and you're going to get reimbursed, but you have to expense it and it takes time to get it back. All of a sudden that balance is now $9,000, okay? You're 90% charged on that credit card. A new credit inquiry, consumer credit inquiry, not necessarily mortgage, if you're applying for an auto loan or if you're applying for another credit card, when your accounts are almost maxed out and you get another inquiry, it will drop your score more than if your balance is low at the time that you get the inquiry.
Yeah.
If you have a $1,000
So we're talking
balance,
about like utilization.
utilization.
That's the key word.
The utilization, the amount of credit that you're utilizing, right? The more it is worse. Like you use the lowest amount that you can. And so if you have a $1,000 balance on a credit card and you get a credit inquiry, it might only affect you a couple of points. If you're almost maxed out, especially if you're across the board, maxed out on multiple accounts, you get a credit inquiry. I have heard of one inquiry dropping scores as much as 40 to 60 points.
Yeah. So the short version is, if you can time the credit pull to be when most of your balances are low, let's say below 30% utilized. So if you have a $10,000 limit on your credit card, please keep it under 30%. Keep it under $2,000 would be even better instead of $3,000. So the lower that balance is, then the better your score can show.
That's right.
At that time.
And a very important distinction is a mortgage pull is different from a credit card pull.
Sure.
Is different from an auto loan pull. We've had some horror stories from clients call me and say, we just went and bought a car, and because when we pull the soft credit pull, all the recent inquiries from the last 120 days shows up, and all of a sudden it's Ford, GM, Hyundai, Lexus, whatever. They've got a million credit pulls on their account because they either shopped multiple dealerships, or sometimes a car dealership, one dealership will pull your credit a dozen times when they're in the back room trying to figure out your financing.
Or the worst is if you use an online that shops it out
That's
to
right.
other vendors.
Yes. And those are national names of websites that you'd know.
Those are naughty. Don't do it. Don't do it.
They're pulling your credit multiple times. And a lot of times it's multiple hard pulls. And so if you get a dozen hard pulls in one day, it's obviously going to impact your score, more so than just having like one soft pull or one hard pull on a mortgage. So we could talk about credit inquiries all day. Like there's a lot to unpack on the credit inquiries.
We have, on that note, we do have some deeper dives into different topics. We're hitting almost episode 60. So episode 9 is on O credit. Episode 16 talks about home buyer certainty. And we go into making sure your pre-approval is like locked tight. And we talk about credit. 29, shopping your lender. So one of the things I want you to hear is do ask your lender if you can make sure it's only a soft pull for your pre-approval. Because that is a big deal. You don't need a hard pull right up front. We're pretty strong about that opinion. Other lenders might tell you otherwise, and ask them why. So just push back a little bit.
Yeah, exactly. Just ask the questions. What is your process? What is the reason that you pull a hard pull or versus a soft pull? For certain types of loans, let's talk about that. Have a hard pull.
So one of the legitimate reasons might be you're getting a VA loan.
Yeah.
Right? And you think your credit's pretty decent. You have no reason to believe you have bad credit.
Right.
At those points, it might be best just to get a straight hard pull. What I still do like the soft pull for is if people don't know their credit score.
Right.
And that could have a different timing of when they're going to buy.
Yep.
So if we're just peeking under the hood, even though you're going to be a VA, a soft pull doesn't hurt anything. And so it just gives us that starting point.
It does. And I have an example just today. This is some past clients of mine, and they've built a very successful business through the last 30, 40 years. They've amassed a very significant net worth. They could probably write a check for the house that they're buying if they really wanted to, but it makes more sense to keep their money in their investments and take out a mortgage. And the gentleman did not know that there was a medical collection on his credit. Credit scores are impeccable. Like it never missed a payment on anything. And that's a whole nother topic about how medical collections shouldn't be on your credit report.
Right.
But this particular medical collection was showing up. It's actually costing him about 80 points. We're working with him right now to get that resolved. And then that score will go back to where it needs to be. And it's actually impacting their rate. It's about 1/4 point to 3/8 of a point on their interest rate because of the credit impact. Does it impact their ability to borrow the money? Not at all. Like they're certainly approved. Like I said, they could probably write a check for the house, but in this moment when we're locking the loan, they've got this silly medical collection that's costing them on a pretty sizable loan. It's about $200 a month on their payment. $200 a month over 5 years, 10 years. I mean, it really adds up.
It really adds up.
So the other benefit of the soft pull is that we get a sneak peek of, oh, there's a little snake in the grass that we didn't know was there, or our client didn't know was there. This happened to a family member of mine where there was a medical collection they didn't know about. And so we were able to resolve it pretty quickly. And that can take a week or 2 weeks, especially if you're not in a hurry. Gives us time to get that credit, one little blemish resolved, and then we can pull the hard pull when we're ready.
Yeah.
And those hard pulls last 4 months. It's like, that's the other question. If I get a pre-approval, how long does that last? It'll last 4 months. So if you know you're buying in the next 90 days, the timing of your hard pull is less important. But if you're not buying for 6 months, get the soft pull. We do the soft pulls anyway, but the soft pull's beneficial because we don't need a hard pull yet.
Yeah.
And it's going to expire if we did pull one.
Right. No, that's a good point.
Yeah.
So I hope what people hear is just making sure that you don't need to wait to do your credit improvement in order to apply to talk to a good lender, as long as you know they're doing a soft pull. So I hope that's what people get out there. If you're a realtor out there and you hear your clients just are waiting to apply to make sure they got some credit improvement, make sure they just apply with a local lender you know and trust that does soft pulls, because the quicker we can get a good scenario for a borrower, the quicker we could roadmap a success story for them.
That's right.
Right?
That's right. Yeah, I mean, really, it starts with that first step. It's a big step for a lot of folks. We know that making that first call, having that kind of getting financially vulnerable, credit vulnerable with someone, we understand that's a big step.
Yeah.
We've been doing this for a long time. I'd like to say we've seen it all, but I kind of feel like I see something new every day, which is great. But we've seen a lot.
It seems that way.
It seems that way.
Yeah.
We've certainly seen a lot of situations, a lot of circumstances, and we'd love to help you as well. So
Good.
Thanks for watching today. Thanks for listening. We're here if you need anything. If you have questions, reach out.
Yeah, thanks. And like, subscribe, share to the Lending Podcast. Our goal is to be there for you. Comment down below if you want to hear something from us. But thank you.
Thanks so much. Take care.